right, good morning, everybody. This is Jenny Hartley, the Economic Development Specialist here at IMPA. First off, wanted to say thanks to all of you for taking your time out of your Tuesday to either refresh or learn about our customized impact dashboard model. So this model estimates the different economic and fiscal impacts of our new economic development projects based on user-entered info like projected employment, salaries, and capital investment. So we kind of hope that this webinar will be a great tool for you all to use to learn how to use this and to analyze and organize all of our different economic development projects that come through. So with the folks from Impact Dashboard, we're for the next hour going to be learning a couple different things, including components necessary to create an economic and fiscal impact analysis, incentive analysis tips, Impact Dashboard new features, and then some future updates that we may or may not know about yet. So if any of you have any questions regarding Impact Dashboard, feel free to reach out to me or any of the folks at Impact Dashboard, and we'll go from there.
All right. Thanks, Jenny. My name is Paul Shurin. I'm a principal and economist with Impact Data Source, the company behind Impact Dashboard. So today, just as Jenny described, we're going to kind of walk through the model and discuss a lot of the different elements of how to use the software and kind of bigger issues around modeling the impact of economic development projects. So first off, I'm just going to show a couple of screenshots from the model and talk about what we're seeing and what we're looking at. And this is kind of going to lay the groundwork for where we're going with the model and evaluating projects overall. So these first two screenshots on the left-hand side, we're showing a little bit of a summary of the impact of a hypothetical project here. This project is going to create some new jobs in the community. The model is accounting for and estimating the spin-off jobs to be created. So not only the direct jobs that the company itself might be creating, but then the indirect and induced jobs being created elsewhere in the community. So in this example, we're seeing 50 direct jobs and about 20 spin-off jobs. We're also noting the salaries that would be paid to the direct workers, on average about $40,000 to the direct, a little bit less to the spin-off workers, and so across the average of all of the new workers, about $36,000. We're noting that this project includes a capital investment of buildings and FF&E, furniture, fixtures, and equipment, of about $2.4 million. And this happens to be a plywood manufacturer. And then finally, the large graph at the bottom that you see on the left-hand side is showing us what we think is really some of the most important information for economic developers in evaluating projects. And that's the stream of revenues and costs associated with this project over, in this case, 10 years. So we see that the project is going to generate about $400,000 in benefits, about $155,000 in costs. So our net benefit from this project over the next 10 years is going to be about $250,000. And we can see what that looks like graphically year by year, relatively consistent over time there. Now, the other type of information when we kind of go deeper into this is presented on the right-hand side to show us what are the specific revenue sources and what are the specific costs being incorporated into the analysis. So if we see the net benefit of $254,000, what are the specific tax revenues? What are the specific costs? And so in this example, it's probably not the best example to show for today with Indiana, but we've got sales taxes. And in this case, these are the sales taxes received by that city entity. So in this case, this is my city. This happens to be kind of representative of a Texas community that has a local sales tax. You won't see that in your model for Indiana, but you will see income taxes. So this one is showing you some of the possibilities. When we look at your model today, we'll see what are the sources of revenues and costs specific to local Indiana communities. So the other thing that we're going to get into with Impact Dashboard, and that's pretty common among economic development projects, would be looking at incentives. And so that could be things like property tax abatements or rebates or exemptions. We're showing here also sales tax rebates and so forth, which probably don't apply at the local level for Indiana communities. And then we have another category, which is kind of front and center here in my screen, called generically, it's called just a non-tax incentive. And this is intended to be anything that is either a cash incentive or a near cash incentive. So this could represent, a job creation grant that you're providing, or some paid for infrastructure improvements that the city or the EDC might make on behalf of the community. And then it could even mean if maybe the city owned a piece of land, or the ED organization owned a piece of land and they were going to be providing it to the company at a discount or maybe even free. You could put the value of that incentive in this. And what we're going to do is treat the value of the incentive, this non-tax incentive, as an investment in the project. And that investment will be compared to the net benefits that the project generates over the time period. So again, in our case, we had net benefits of $254,000 over 10 years. That represents our return on our investment of $75,000. So with that information, we calculate a rate of return and a payback period. So you can really get that ROI on your incentives. In this case, if the project received $75,000 in a job creation grant, the city would be paid back in 2.5 years. So the city would receive enough revenue to cover the value of that incentive through 2.5 years of the project. So just as we've discussed this a little bit, I'll kind of take a moment just to kind of show how this comes together in an actual one-page report that gets generated by Impact Dashboard. For economic developers, we generally think that the most important pieces of information to evaluate an economic development project are going to be the economic impacts, the fiscal impacts, and then an incentive analysis. And all of that kind of touches each other and comes together in one report in our analysis. So first off, if we look at the economic impacts on the upper right-hand corner, this is where we can see the number of direct jobs and spin-off jobs, the direct salaries and the spin-off salaries. So those are kind of always a focus point of our analysis. But those economic impacts then translate into fiscal impacts, those additional revenues and those additional costs for the particular government. So in this case, we can see our fiscal impacts are noted on the left-hand side, both with the graph that goes over 10 years at the top and then the detailed table of the specific benefits and costs. And then finally, that incentive analysis, that's where we use the return on our investment, the net benefits to the community, and we compare that to a potential incentive. And so that's where all of these pieces kind of work together and kind of feedback into the analysis. And we put it all together here on this one-page report. And then in our model, we have the option for the one-page report as well as a detailed kind of narrative, a report with a more typical narrative. So before we go any further, I just want to kind of explain the two different names you'll be seeing. So Impact Data Source is the name of my company. So it was created by my partner, Jerry Walker, in 1993. Again, my name is Paul Shurin, that will be presenting here today. Impact Data Source is specialized in providing consulting services specifically related to economic and fiscal impact analysis. We work with economic development organizations and other governments to help them understand economic development impacts. And so most of our consulting clients, when we prepare a report for a client, they're considering some type of economic development agreement or other incentives. Now, out of that consulting work came Impact Dashboard, which is the product. And this is what you all have access to through IMPA. And Impact Dashboard is a web-based app. We have over 100 clients using the model across the country. We can see we have communities that are less than 10,000 in population to large metro areas, multi-county regions, and organizations like yours. And so the Impact Dashboard is a web-based tool that you can use in-house to run the impact on these types of projects, economic development projects, throughout the year. And so we're going to go through and take a look at some of the nuts and bolts of entering the information in, looking at the reports, and then the organization in the actual app, and how you can evaluate different scenarios and different projects. And so let me jump right in, and I'm going to do that by going kind of all the way to the end, so to speak, of the type of output you would see in Impact Dashboard for a project in Indiana. And so here I'm looking at a project in Miami County, Indiana. And again, this is that same format that we just saw with some highlights. So in the upper right-hand corner, we've got our economic impacts. This one happens to have 200 direct jobs. The average salaries are about $50,000. There's a capital investment of $7.5 million. Now, based on those economic impacts and based on the tax structure that's in Miami County, we're estimating benefits, costs, and net benefits over the 10-year period in this case. We're showing net benefits of about 1.8 million. We can see it kind of ramps up over the first couple of years and levels off. That's always an interesting thing to point out, is just to understand, is the net impact increasing, or is it decreasing, or is it staying flat? Just to get a sense, does it jump up in a particular year or something like that? So getting a sense of how those net benefits will accrue is useful. And then again, for Miami County here, we can see what are the sources of revenues that the county will receive. So we've got line items in our benefits for real property taxes, FF&E property taxes. So those are the kind of the business personal property taxes for FF&E. And then income taxes, and then new residential property taxes. Building permits and fees has a line item there. So if the county was going to receive some, just building permits and fees that were paid directly to them, we could incorporate that. We have a line item for miscellaneous taxes and user fees. That includes kind of all the other sources of revenue that the county receives as a result of new development, new projects, new residential and business activity. We look at the county's budget to see what are the sources of revenue. Those things that we're going to try to itemize directly, which are those kind of big drivers of real property taxes and income taxes and different types of property tax. Those are going to be estimated directly. We exclude those, and then we just look at what's left over, and we think about how does that increase, or does that increase as we have an increase in business activity and residential activity. So that's what's captured in miscellaneous taxes and user fees. Then on the cost side, we're estimating a cost to provide county services, so to speak, to the new businesses and to the new households that might locate in the community as a result of the project. And so we're estimating the impact there. So that boils down to our net benefit of 1.8 or almost 1.9 million. And then in this analysis, as we can see in our incentive analysis screen, we've got an $800,000 incentive, which is $4,000 per job. And that's being compared to our net benefits. Again, that's the 1.88 million. And we can calculate our rate of return and our payback period right around 5 years. 4.7 years will be the point at which the county collects enough to cover that incentive. So we've been looking here on our report tab at our summary report for the county. We could take a look at the impact or the summary report for the municipality. So here, the town of Amboy in this case. We can see the sources of revenues that it might receive over time. And how that looks may be different from the county. We also have, as I mentioned, the detailed report. This is, if we go to the top here, this is going to be that more traditional report that you can print off, and it might be 10 to 15 pages long, and just work through the entire analysis as we go here. So we're looking at kind of the outcome, but let's take another step backwards, so to speak, and look at how that information came together in the model. So the great thing about Impact Dashboard from the user's standpoint is the only information you need to bring to the app is the information about the project that's going to be created. So you don't need to worry about all the tax structure information and about maybe how the local income tax gets split between different entities, or what the local property tax rates are. All you need to know are the project specific information. So we're taking care of a lot of that background information, and the information that you see on this screen is all that you would need to provide. So now I've already entered in some of this information, so we'll take a look at what those inputs are and how you can change them. So I'm going to click first on this description tab in the upper right, or excuse me, upper left. We've got the ability to give this particular scenario a title. We're in a project called Project Zip. We'll look at more of the kind of structure around how to create projects in a moment. But we're calling this scenario 1, and then we can provide a description of the project here in our text area. And this description, as it says, will be shown on the first page of the detailed report. It's not going to show up on the summary report, but this narrative can help provide context to that detailed report. We've created the ability to put some bullets and different types of formatting in this, so you can do list items and different things. And you can format tables even and bullets and paragraphs very nicely here if you need to kind of get a really polished description in your report. I will say, from looking at some of our clients' projects, very often this description isn't used. So you don't have to use it. If you don't put anything in here, it'll just skip that section of the report. You won't see a project description in the report. But you can certainly add in a lot of narrative here to help provide that context. Now, we're here on this description tab. We're going to click next, and that's going to pull up our location. So this is where you can select where the project is going to be located. In your case, in Indiana, we've built in essentially the entire state. So you can select the county here. I've selected Miami County. You can select wherever your project is located, obviously. And then the second drop down that we see here is the specific tax district area. So in my case, I was selecting Amboy Town, and if I select that, once I make that selection, it'll fill in the appropriate taxing district. So we have 6 tax entity or tax districts here. It's Miami County, Jackson Township, Town of Amboy, this particular school district's library district, and then special district if that applies. And so the only thing that you have to identify would be, number 1, the county, and number 2, the specific tax district area. And that's going to dictate which tax districts are incorporated. Now, we also have the ability for you to enter a particular address in the map here. If you want to, you certainly can, and it'll throw a pin on the map, and it'll incorporate all that information. But I will point out that these two pieces, the selection of the tax districts and the project location with an address, these two things are completely independent, completely separate. So you absolutely need to identify where the project will be located to pull in the appropriate tax districts. And then this specific address is just a nice to know. So I think there's a little bit of confusion here, just the way it sits, that if I put in the address, will that identify which tax districts apply? Unfortunately, it's not that sophisticated, and that would not be the case. So presumably you could put an address that doesn't make any sense here. So Austin, Texas, which is where I am, I can put Austin, Texas, and that had no effect here on these taxing districts. Obviously, the project is still going to be assumed to be in Miami County, Indiana. So just be aware that the address is just nice to know, add information, but this is kind of must enter information on the taxing districts. So if I hit next, I can choose the industry. So this is where we're going to get to choose the NAICS code for the company that we're evaluating. So in my example here, I've plugged in general warehousing and storage, and I've gotten my multipliers. And let's just say I wanted that this was a different project and I wanted to put in a different industry. What you can do is plug in this case, it has a nice little search feature. So what you can do is plug in the NAICS code. Let's say I know it's farm machinery and equipment manufacturing. I start typing the NAICS code associated with that, and I find it here, and I can click on farm machinery and manufacturing. Otherwise, if I didn't know the NAICS code, I could just start typing some words like we had the warehousing. And as I type those words for warehousing, we can see I get a handful of options around the warehousing and storage. I'm going to select that one, and it adjusts the multipliers based on what I'm using. And so we're using RIMS 2 multipliers here. The way to interpret this, as it says, a type 2 employment multiplier of 1.3. The way to interpret that is that for every direct job that's created by this company, there's going to be 1.3 total jobs created. That includes the 1 direct job and then 0.3 spin-off jobs. So that's the way that we can interpret that multiplier. The earnings multiplier is going to be somewhat similar in the interpretation, where for every dollar that gets paid to a direct worker, there's going to be 1.3 1.3, so call it, $1.3 paid to all of the workers. That includes the $1 paid to the direct worker and then the 30 cents paid to the spin-off workers. And so these multipliers, they're not always going to be so close to each other necessarily, but they happen to be in this case. So if you see one at 1.5 and the other at 1.3, that's certainly fine. This is just happens to be a coincidence. If we want to, let's say that we were working on a project where, let's see, some of the stakeholders didn't want to account for any of the spin-off activity and we just wanted the direct impacts only. You can do that. You could click here with enter custom multipliers, and now we can just plug in a 1. So we want to use a 1 to reflect the fact that if there's 100 direct jobs created, there's going to be 100 total jobs created. And so if I do that sort of thing, and if I close this, we could see behind it, there would be 200 direct jobs and then 0 spin-off, and the spin-off wouldn't be reflected here. Now, in the results, we see our net benefits being about $1.5 million. That's, again, focusing only on the direct impacts and excluding any of that spin-off activity. So in our case, I think it was about 1.88 million before, when we had the multipliers included, and now it's 1.5. So we lost about 300,000 over 10 years just from removing that multiplier impact, but really doesn't seem to be driving the analysis in this case. So I'm going to go ahead and put that back in just so we keep that going. Again, I'll type some words here until we find general warehousing and storage. Now, what we're looking at here, so we've got these first 3 screens that we looked at. They kind of pop up as modals over the entire screen, but the rest of this information is that project-specific information that can all be entered on the left-hand side. The first item that we see there is an input related to jobs, and we see a handful of inputs over the first 5 years. So this is where we can actually account for jobs being created or phased in over the first couple of years. In my case, I plugged in 100 jobs in year 1, 50 jobs in year 2, and 50 jobs in year 3 for a total of 200. That's where we've been seeing this 200 direct jobs the entire time. Now, if I wanted to, if I was interested in having jobs phase in through the entire 10-year period, we could certainly do that. And if we click on these little arrows here, we'd be able to see all 10 years of those inputs. And now, while we're looking at this one, and I think most folks are set to a default of 10 years, we can make changes to that. So if we wanted to run this analysis not over 10 years, but over maybe 15 years, if we go up here to our settings, this is where we'll talk about a lot of these different settings, but maybe just start off with an easy one here related to the number of years. If we click on settings, we're going to go into an area where we can change all of the settings or parameters that we've got set up in the model. So if I click here, I can see that actually I can't make changes to any of these things just by default. If I try to click on these, they don't allow me. What I have to do first is click Edit Defaults. Once I do that, it'll tell me I'm now able to edit these defaults, so I can click on certain things. The one we want to change is down here with the scenario length in years. So let's just change this. So we don't want to do 10 years, we want to do 15. And so as I do that, everything extends out to 15 years. And so even our calculations now, the net benefits are being calculated over a longer period of time. And our inputs, even if we wanted to have jobs phased in over 15 years, we could do that as well. So you're not stuck with that 10-year look. You can adjust it to whatever time frame you'd like. The other thing I'll show, the information on this right-hand side updates in real time. So if we wanted to say actually it's going to be 200 jobs in year 1, you can see everything kind of recalculates and updates just as you're looking at it. So you get to see those snapshots of your results as you're entering the information in. On this right-hand side dashboard, you can see we're looking at the county. If we wanted to take a peek at what's happening for the township or the city or the school district or any of these other entities, we can click across here and find each of them. I'm going to stick with the county if maybe that's more of our focus. So that's our entering jobs. If we hit continue here, now we have an input related to workers relocating. So this is the idea that if you create 200 jobs, if they're going to hire 200 workers in Miami County, how many or what percent of those jobs will be filled by people who relocate to the area. So if we just kind of take a minute to think about the possibilities here, when we create 200 jobs, Some of those positions will be filled by people who already live in the county, and that would be great. That's probably what we're hoping to do. Some of the positions, as a second alternative, might be filled by people who live nearby. So they live in a neighboring county and they're going to commute in, or they live somewhere else, but they're going to work in Miami County. And that's possibility too. But then this third possibility that we're talking about, that we're trying to get an estimate for, is where you would have some of these jobs being filled by people relocating to the county to fill those positions. And so right now we have a default in there. We have a default for each one of the entities. So you won't really have to worry about the default too much, but you can override that default based on the information you have. So this one happens to be, we were considering just a warehousing and storage project, and we were creating 200 jobs, and we can think about, well, and this would be something you need to work through. You might say, well, based on our local labor force, I feel like we have enough people to fill these positions, and there won't be very many people relocating to the area. So in that case, we might click override the default, and let's plug in something a little bit lower. It could even be 0, but I'll just put 5. So 5% of the workers would be relocating to the area in this case. And so that's one scenario. Another case, you might be told that the company's relocating from outside of the state. They've provided, some relocation assistance for a large chunk of their employees. And so in that case, maybe you know that this isn't, even the default, which was more, maybe 21% was the default originally. Maybe you say, well, actually, what they've told us, we think maybe 50% of those 200 positions will be filled by people that relocate into the community. And there's a lot of factors to consider around this. As I mentioned, one of them was that local workforce, the labor force. Do you have the folks that can fill these jobs? And then you might narrow that down even to the specific positions that are being created. So if it's like, in this case, if it's material handlers, you could think of that as, well, maybe we have that type of worker that's available. And since the positions don't pay a lot of money, maybe people aren't going to really relocate for it. If it were something different, maybe they're more specialized occupations, which you currently don't have, and you're going to have to recruit those types of folks. That might play into the decision here on what you would put for the percentage of workers relocating. I'm going to just stick with the default here as we go, but you can certainly change it. We have these little tool tips to help us think through these questions. So as I walked through earlier, this just describes those 3 possibilities of workers filling those 200 positions. Some might be local, as in they live in the county, or they live nearby and they commute, or you would have folks who would relocate to the area. If I hit continue here, we have an input related to salaries, and this one's a little bit different than some of the others. We're asking for the average annual salary every year, and we make it easy for you by giving you a % increase. So I'm going to just show as many of these as we can so we can see our 15 years. Let's say I wanted to change this. I'm going to put it at $40,000, and I'm going to say that it increases by 3% per year. If I do that, we can apply that 3% all the way down over the 15 years. This is what we're doing there with the 3% increase. This just is intended to save you a few taps of the keyboard, so you don't have to type in or figure out what these values might be all the way down. Now you could certainly, if it was going to be flat, you could put in a 0%. Probably not realistic, but you could certainly do that. But let's just put in let's go back to our 2%. And you can also overwrite individual values. So perhaps it's going to be $40,000 while they're hiring. So these first 3 years would be fixed at 40%. And then only in year 4 does it start to pick up at the 2%. So any of these individual years you can overwrite if you need to, but otherwise, if you haven't overwritten them, it'll just increase by 2% from that point forward. So it's a nice little shorthand so that you don't have to enter all the values every time. If we click continue here, now we're asking about capital investment, and we also include a column for the land. And so I'll talk a little bit about these inputs here as we think about how this translates into taxable property and how we calculate the tax rates in the model. So the fact that we have a column for land, generally speaking, if I'm doing an analysis, I won't put anything in the value of land. There are some instances where it makes sense to include the value of land, and so in those cases I would include it if you had a piece of land that was excluded from the tax rolls. So for example, if it was owned by the city, but as a part of this new project, you're selling it to a private company. And so whereas it was previously not on the tax rolls, it will in the future be on the tax rolls, and the value of that land is $200,000, you would plug that in there. And so you could put that in there. So we're thinking about the market value in that case. So that's how you would use the land column. I wouldn't, generally speaking, I don't put anything in there. The other column that we have is buildings and other real property improvements. So this is generally intended to represent the investment that the company is making in property and so forth. So I've put $5 million as the investment in real property improvements, and I've put in $2.5 million as the investment in furniture, fixtures and equipment, and machinery, and all those sorts of things. So the business personal property. And so we add all this stuff up. It's all happening in year one. If we were going to have, maybe a second phase, or if this was going to be, accruing over time, maybe we would have another 5 million, whatever might happen, or 50 million if you mistype. But in this case, I've got everything added in year one, $7.5 million. And what we can do is we can see how this translates into taxable value in our model by taking a look at a table in our results in our detailed report. So I'm going to jump around for a minute. We're going to come back. We're not done going through this scenario info screen, but just to show you in the report, if we go to our economic impact overview, the third table is going to be our summary of taxable property over the 15 years. So we're really focusing here land, buildings, and FF&E, these three columns relating to the firm's property. We don't have anything in land because we didn't put anything in there. Buildings, we see 5 million, and actually if we look closely over time, that increases in value through the 15 years. The FF&E that we had plugged in 2.5 million, so we see 2.5 million here, and then it declines in value. What we've got going on with both of these is some assumptions in the background that indicate how much of that investment will come onto the tax rolls and then how it will adjust over time. So with respect to the building, we've entered 5 million. We can see that 100% of that investment is representing market value or taxable value on the tax rolls. So if we wanted to, we can adjust that. So let's say that they were going to spend 5 million, but it might only come onto the tax rolls for 4 million. So what we can do, again, we're going to go to our settings. Anytime we need to make an adjustment that isn't obvious on the page, we can just go to our settings and try to find it. So here in our general assumptions, we have an input for the percent of building and improvement costs that represent market value. By default, it's set to 100%. So that means they spend 5 million, 5 million is on the tax rolls. In our case, we want it to be 80% coming through. So they spend 5 million, 44 million is on the tax rolls. So if we go back to our report, we'll see now we're capturing the 4 million in building value, but we haven't adjusted this. It's still 5 million here. We still have the total capital investment of 7.5. Now the other thing, I'm jumping around real quick, I apologize, but here we have this still increasing over time. And what this is, it's the assumption in the model that we have 2% real property appreciation. So if we go to our settings, we can adjust that as well. So for example, if we didn't want that to be the case, commercial and industrial real property appreciation, we're going to set that to 0. And we'll see that now our $4 million will be flat over time. So no change over the 15 years. Now, we still have this other column over here. The $2.5 million investment starts out as a taxable value of $2.5 million, and then it declines in value over time. And what you see happening there is really a function of our depreciation schedule. So for FF&E, we're going to apply the depreciation schedule that you see here. You can go in and adjust this if there's a specific depreciation schedule you want to apply. You can plug that in and modify it however you'd like. And I'm not going to do it right now, but if you make those changes, you would see that reflected here in this table, kind of going over time. One of the cool things, I'll just point back over here on the settings, is you can see we've modified this input. We can see we're reminded of that with not only this yellow bar underneath, but the fact that it's identifying the default value that was originally there. Now, if we've made a bunch of changes to these assumptions and we decide we didn't want to do any of those, you can hit reset defaults, and that would just clear all of the assumptions that you've modified and put them back to the original default. if you want to just change one or two, you can see that, you just go here and you can type in the default that's noted here, and it'll go away in terms of the yellow bar. So that's how to control some of those calculations in regards to capital investment translating to taxable property. The one thing I'll point out is, let's just make this easy on the math maybe. If we added additional property, say in year 5 of $1 million, in the report we would see year 5 that we'd bump up another $1 million. So we have kind of the depreciation schedule applying down, and then the new property coming on here in year 5. So for $1 million plus the $1.5 million that was originally associated with the year 1 property. And this $1 million would then begin to start to depreciate according to its own schedule. So there's kind of cascading depreciation schedules based on when that investment was made. So it all kind of works as you think it would. I'm going to take that out just to make things nicer. So that's our capital investment. Then the final piece of information that we're asking for is building permits and fees. These are revenues that would be paid to the county associated with that construction project. Maybe I'll just make something up here as we do this. Say $50,000 would be paid to the county. And so that just reflects an additional revenue to the county. So once I do all of those things, and we didn't really change a whole lot, but we can go back to our reports and we can see what are the benefits, costs, and net benefits. How does that compare to our incentive that we were considering, and all these different impacts. Now, one thing we didn't talk about yet is this public support tab. This is where you can model different types of incentives. We've got, in your case, in Indiana, we've got just a handful related to, number one, property tax abatement or rebates and that sort of thing, as well as those non-tax incentives. So if I'm on this public support page, we can see I've got different tabs for each of the tax entities. So if the county were considering an incentive, and actually that's what I had plugged in here earlier, if they were considering an incentive of $4,000 per job, we can see that analysis here as we take a look at it. We could even plug in different values. If we didn't like 4,000, maybe we could try 2,000 and see how that looks. In this case, we've got the incentive being paid out over 3 years, kind of consistent with the hiring schedule. So every time a job is created, we're hitting $2,000 on there. And then this graph, just to kind of be clear about what we're looking at in the graph, the orange line is showing us our net benefits over the time period. In this case, over the time period, it's a little over $2 million. And then we're comparing that to the incentive that's being paid. These gray boxes down here are the actual incentive amounts paid out over time. And then this gray dashed line represents the total incentive paid if we kind of stacked all those boxes on top of each other. And so in this case, we've got $400,000 incentive compared to our net benefits here of $2 million. Means our payback point is just around 3 years. So again, we can interpret this here. The city, or excuse me, the county will collect enough to cover the value of this incentive through 3 years. And then the rate of return, we can see how we're calculating it there. It's really just the average annual rate of return. We don't have to do an incentive per job. That's how this has been set up for the time being, but we could specify a payback period. So for example, if we knew that the county would consider an incentive for this project, but we have to be paid back in 5 years, if we put in 5 years, we can calculate the incentive that's associated with a 5-year payback period. So now we've got kind of a weird number, $722,000, but it gets us paid back in exactly 5 years. Now you can play with this and kind of come at it from any angle you'd like. And so if you wanted 3.5 years or whatever it was, you can also do just the straight incentive amount. So this might be the more common one. So if we're going to give them an incentive, maybe we pay $500,000 in year 1, and then $500,000 when they're finished hiring. We can see those two payments being made, $500,000 and $500,000, the total $1 million here, and our payback point is right around 7 years. So that's how this non-tax incentive calculation works. And if you, just to remind you, these net benefits are the county's net benefits. So this is an incentive that we think, the $1 million in this case, being provided by Miami County against the net benefits that the county would receive. If the city were going to be providing an incentive, you would compare the city's investment against the city's return on that investment. So in this case, maybe the city was going to offer $250,000, just making up some numbers. And in that case, $250,000 has a payback period of 6.1 years. Again, comparing the amount that the city provides against what the city receives in net benefits. So the other incentive that we haven't looked at that's on all of these pages is that property tax abatement. So I'll go back to the county. We'll take a look at this. So we have, as it's labeled right now, a property tax abatement, but we can choose the language around this if we wanted to. So if a property tax exemption or a rebate or a reimbursement, we'll use property tax abatement. If you wanted to provide an abatement on the company's new property that they were adding, the building property, the real property, we can plug that in here. Maybe we're just going to do it over 10 years. And the last 15 years, we could put it in, but I'm not going to. Let's just say that it stops at 10 years. So we're going to exempt 100% of the building taxes over 10 years. And then the last 5 years, we'll get to keep all those property taxes. So that's what we get to see as this analysis unfolds on the right-hand side. So the county is expecting to get property taxes, as we can see, is in these dark blue bars. So based on the county's portion of the property tax rate, the county is going to get $527,000 over the next 15 years. Now, if we offer this abatement over 10 years, 100% on the building, we're going to give up about $25,000 to $27,000 a year. So that's an abatement valued at about $270,000. So our net to be collected is only about $257,000. And so that's what we're kind of graphing in these orange bars. By years 11 through 15, we're getting kind of a big chunk of it, but we're not getting so much in these early years. This is nice in a graph format. You can hover over these and see the values. But the table here can sometimes be helpful if you want to get the actual raw values pulled out for each one of these. So there, you can take a look at that. Again, if we wanted to call this a rebate or a reimbursement or whatever the terminology, the math is going to stay the same, but the language will update here to kind of reflect whether it's a reimbursement or an abatement or whatever. So if we were to kind of stack that into our report, what's going to happen when we do that is we're going to get an asterisk here that tells us the real property taxes have been adjusted. So we see we're only getting $156,000. That's because we're doing this property tax reimbursement of $270,000. And so we've pulled down, we've reduced our net benefits by that amount, the $270,000. So again, if we're comparing $1 million incentive against that, our payback point is 8.2 years, which is longer than before we plugged in that abatement. So just to kind of show how this is working, our net benefits are affected by this property tax reimbursement. So that recalculates our numbers here. So let me just kind of show, right now it's 8.2 years. This net benefit line is kind of pulled down, so to speak. It's not as high as it would be if you didn't offer that abatement. So what I'm going to do is uncheck this box at the top. What it's going to do is going to give us back the $270,000. It means this orange line is going to shift up and our payback period is going to shorten. So as I click on that, we get our money back. Our net benefit stretches up higher than it was, and now our payback period has shortened to 6.8 years in this case. So that's just some of the dynamics here of what's going on as you layer some of these incentives on top of each other. So again, you can do this from the perspective of any of one of these entities that you choose. And one of the new features that we've added recently has to do with the option of looking at this kind of community-wide. So if you wanted to look at not just an incentive provided by the county against the county's net benefits, what you could do is look at this as an investment across the community that would be paid back across all of the entities. So now what we can do here is basically build this analysis. So in my case, my example, what I want to say is we want to compare $1 million incentive against the net benefits for all of our districts. So I'm going to select the participating districts for this community incentive, and I'm going to select all of them. So we want the county, we want Jackson County, or excuse me, Jackson Township. we want the town, we want the school district, the library, and then our waste district. So now we have this orange line that represents our net benefits to all of the districts, and it's up over $4 million over the time period. And now, if I put in, let's say, that same $1 million, and we're comparing it not just against the county's net benefits, but against all of the net benefits to be received by all the taxing districts, we can see it's a 3.5-year payback period. And we get a footnote kind of telling us which districts are included here in the net benefits. And if we scroll down, what we can do in addition to just applying this and getting our 3.5, if we wanted to, we could allocate this incentive across all of the taxing entities. We don't necessarily need to do this, but we can, in which case, if we have 6 districts and we're going to have $1 million incentive, we just divide 1/6 of that to each of those districts, and based on this allocation percent, equal allocation percentage. And now we can calculate a rate of return and a payback period based on each of those, kind of, as we would say, kind of chipping in the $166,000. Now you can see some of these for the township, it's a pretty long payback period, and the library district, it's pretty long. The waste district actually isn't identifying any revenues. So what we could do is make this proportional to net benefits, and then you just allocate the $1 million incentive based on what each of those districts are really receiving. So in this case, we're giving a kind of the largest portion of the overall net benefit is received by Miami County, and so they are on the hook for the majority of this incentive, in this case $500,000. But in this case, what we're doing is equalizing the rate of return, so then our payback periods are a little bit similar. If I were to scroll down further on this community incentive, we'd be able to see that one by one analysis. So here's the 543 compared against the county's net benefits, and then the township's 6,000 against what they receive over the 15 years. I won't go through all of those, but one thing that does come up is this new report that we have in this community report, where we can configure which districts are included on that report. So now this is a one-page report that shows the benefits, costs, and net benefits to each one of the tax districts that's included. And we can see in total the $4 million in net benefits, and in total kind of our 3.5-year payback period. So this is a nice new report that we've added in the last, 8 months or so, that you can see a community level report on a one-page analysis. Generally speaking, these summary reports focus on a single taxing entity, either the county, the township, and so on, or now we have the option to kind of show across multiple districts. And it doesn't have to be all of them. So if you just wanted to say, what's the impact for the county and the town, let's get rid of everybody but the county and the town, we can do that and take a look at our overall incentive and return on investment. Again, the detailed report, this one is going to be multiple pages as you print it off, maybe 15 to 10 pages. And this one, it'll include information on all of the districts. It goes into detail on each one of the districts as we go. But we now have this summary report which can hit on all of the districts in one-page report. One thing I haven't talked about is printing. So whether you're on the summary report or the detailed report, if you just click print here, you'll be using the browser's printing. So you need to be sure you're using Google Chrome. And now you can print this off, and it kind of breaks in all the right spots and prints off into a very nice multi-page report. Or in the case of our summary reports, again, this will be a one-page report printed off. My preference for this one is to change our margins to minimum, and it kind of looks a little bit more like a regular old infographic, which is really nice. So that's how you kind of and when I say print, you can save those as PDFs. So what you would do is just choose your printer to save as a PDF here versus, selecting an actual printer. So we've spent a good bit of time here so far just taking a look at the actual scenario. What I want to do is step out and actually look at how you can do different iterations off of this. So what I'm going to do is close this scenario. So if I click up here, I'll hit close scenario. And now we drop back into our Project Zip Control Center. So here is Project Zip Control Center. Here's a list of our scenarios. And this happens to be a representation of kind of what's going on in that scenario that we've just looked at. But let's pretend that we needed to go in and make a change. The company's come back and they told us, actually, we're gonna create 250 jobs, not 200. So what I can do is click copy here. And as I do that, it's going to open up a brand new scenario. It's going to look exactly like our old one, but it's going to be a copy of it. So you can start making changes to this and you won't affect that original one. I'm going to change this one. I'm going to call it 250 jobs, just so we can keep it straight. And I'm going to close that and change this to an additional 50 jobs in year 4. So now we have 250 direct jobs. That's the only thing I wanted to change. That's good. I'm just going to bounce out of this real quick. So I'm going to again close the scenario. But now we can see we have 2 different scenarios on our Project Control Center. We've got our 250 jobs, which is represented right now. And if we wanted to, we can sneak a peek back to preview what is going on with scenario 1. That was when there were 200 jobs and a little bit lower net benefits. And so that is the way that you would create different iterations, and you can do as many of these as you want. So these scenarios will all be listed here as you create them. Now, we can, on this Project Control Center, we can upload documents if we wanted to kind of keep things organized. If we had other materials that we wanted to be associated with Project Zip, we can do that here. We can also apply tags. So if we wanted to identify this one as one for our fiscal year 2020, we could create a tag, so to speak, that is associated with fiscal year 2020. Now, we've been in an individual scenario, and now we're looking at an individual project and all of its scenarios. But we're going to take one step further back to say, let's look at all of our projects. And so that's where we would go to our projects list, and we have the ability to kind of categorize these different projects. Right now we're on our active projects. And so each tile that you see here represents a project. So this is my Project Zip we were just looking at. It includes 2 scenarios. It is tagged with our fiscal year 2020. If we wanted to, let's say that was a project that had a positive outcome, and we wanted to indicate it that it was a project that we had won, so we can move it to our won category. If we click over here, now we would see our Project Zip on that place. I'm going to move it back to active right now, but we can see we've got outcomes for lost and archived as well. And then if we're just trying to find everything, we can click on all. We can filter these by tags, and my only tag here is 2020, so that's the only one we've got there. So that is some of the organization around the number of projects we have. If we wanted to, we could look at this not just as a tile view, but some people might prefer it as a list view, and we can do that as well. If we wanted to, what we've been looking at is this project that I had created with one scenario. What we can do in addition to that is create brand new projects. So here we'll call this new project. Probably not the best title for me to use, but let's create that. And now we have this brand new project. We don't have any scenarios yet. There are essentially 2 ways we can get information into the model. Number 1 would be just clicking add a scenario, and that's going to give us a blank input screen with nothing filled out and all of our tax rate information waiting in the background. In this case, not quite sure what happened there. Let's reload that screen. I don't want to go down that line anyway, so let's go and show the other way to get information into the model, which is by clicking on this Request Data tab. This is where you'd be able to create a data request form for a prospect, and I could put in, if my prospect's name is Bob at xyzcorp.com, I put in that, and I can change this message to say, hi, Bob, and ask him to fill out this data form. What happens if you hit send on this email, it's going to send an email to Bob, and it's going to copy you as the user, and we're going to get to see Bob's going to get an email with a link. That link is going to take him out to a website that looks like this. This page that's loading right now has all of the inputs that we need to complete the analysis. So the number of jobs, the salaries, and capital investment, and so on. So this is the form that you would be sending out to your prospect if you wanted to use that approach. I don't want to do that right now, so I'm going to go back. I know we're getting close to an hour. I didn't realize this was going to take so long. I apologize. I'm speeding up toward the end here. Um, the the other thing that I wanted to kind of just point out while we're here on this page, I'm going to close that, is everyone has their own username and login. So anyone who has requested it through IMPA was given an activation link to create their own account. And so just to kind of show you, this is a page that you're on when you're going to do that. It's dashboard.impactdatasource.com. If I go here, I have, in my case, a login. It could be either a login username or it could be your email address, either one. And then you'll have a password to get you into your app. As I do that, it'll pull up all of those projects we just looked at here as my initial screen when you log in. I will say that you do not. So there is one username and login and password combination for each account. So if you're a community where you have a couple different people that want to have access to Impact Dashboard, you will share the one account across everyone in your organization. And there's no issue with multiple people being logged in at the same time. If you're working on two different projects, both people can be in there without any problem at all. So there's no restriction on the number of users logged in at a particular time. But we don't have multiple, there's not going to be a separate login for a second user on the same account. One thing we've been looking at here so far is kind of our theme that we see as our blue theme. As one of the new features we rolled out earlier this year is the ability to kind of choose a different theme. So based on maybe the colors of your logo or something, you want to choose a different one. We can certainly do that. So if I go back to our different projects, we can see how that transitions from the blue, and it could be instead be a green color. All the different graphs and so forth would be following a green color scheme. So you can change that if you want to choose a different thing. You can also upload your logo if we don't have one in there for you already. And let's see, I think I'm wrapping up here. One thing we wanted to touch on, I think as Jenny noted at the beginning, was future updates, and we are continuing to build features and add things. So throughout the last year, if you go to our blog, we have an update blog, talks about the different features that got released. The big update earlier this year was the redesign, so this new kind of look. If you remember what the old design looked like, this is a little bit different. But then we've added a bunch of features throughout the year. Some of those we went over today in detail, and we currently are working on kind of an advanced data form. So we currently have that ability for users to request data from prospects built in here. We are building in a different feature, or kind of a new feature that will allow you to customize the data request so that you can put in the exact questions you want to include on that data request, and make the information that it captures in Impact Dashboard a lot more robust. So I see that we're pretty much at 1 hour. If there are any questions, I can stick around and answer any questions you have. If you have questions that come up later on, feel free to reach out to me directly. My name's Paul at Impact Data Source. Sorry, my email address is paul@impactdatasource.com. My name's Paul Shurin. But feel free to send me an email, or you can reach out to Jenny as well. Let me see here. So I'm not seeing any questions come in. So again, feel free to reach out if there's something that I missed, or that you have a particular project that you're not quite sure how you could model it using our software. Feel free to send me an email or give me a call. Again, if you're looking to get access, work through Jenny, I guess, would be the best way to ask her to kind of pass that along, since we want to make sure that everyone's approved for access. But Jenny, I think that's everything that I have. Again, I'm not seeing any questions, so
They ask him. Oh, hey, Paul.
Yeah.
So we had one question, and so the question is, can you use Impact Dashboard to look at different residential projects or a non-traditional type of project? And if so, how do you go about doing that?
Uh, it's not, it's really, the impact dashboard is set up to evaluate the typical employer-based economic development project. So a new company that's coming in. Um, I would not recommend, I mean, if you were to, there's a couple steps you could take to try to model a residential project in Impact Dashboard, but a lot of the results are going to look there. Just because it's not set up for that, the reporting will not look correctly or will not look correct, or it might be questionable, even though we could kind of jam some numbers in there to make it reflect a residential project. If there's, and a lot of times with the residential projects, they're important, and they usually are pretty complicated and have a couple extra wrinkles. In those cases, and that's something we do as a consulting kind of one-off basis, if it's really just such a unique project that it needs to be addressed that way. Um, and a lot of those projects around residential, you would have kind of unique assumptions about how many total units maybe, and then how many of those units would be filled by brand new residents to the community. And so if there's going to be, some sort of retirement of the existing housing stock and so forth, there's a lot of moving pieces there that really Impact Dashboard as it is right now is not set up to account for.
Perfect. Thank you, Paul.
Yeah.
All right. Well, thank you everybody for coming and listening to Paul and learning all about Impact Dashboard. If you guys have any follow-up questions, please reach out to me and let me know, and I will get that answer for you.
All right. Thanks, everyone. I appreciate it. Thanks, Jenny.
Bye-bye.